Do you know the number one mistake that I see high earning professionals make when doing backdoor Roth IRA conversions? This is something that is often overlooked and can have huge potential impacts to your financial plan down the line. Before we dive into the mistake that I see most high earning professionals make, I first want to touch on a little bit about IRAs. So we know there's traditional IRAs, which are made with pre-tax contributions, and Roth IRAs, which are made with post-tax contributions. The IRA contribution limit for both types for 2025 is $7,000 for anybody under the age of 50, $8,000 for anybody over the age of 50. Now, for those of you who are covered by a retirement plan at work and are participating in that plan, you're subject to certain income threshold limits with each type of IRA, which will play a part in whether the traditional IRA contribution is deductible or non-deductible, or whether you can do a Roth IRA contribution at all. So for the traditional IRA, if you're single and you earn over $87,000 annually, or married and earn over $143,000 annually, your contributions are not deductible, assuming that you still are participating in your company's sponsored plan. If you're married and only one spouse works, your contribution limit is $240,000 before you would lose deductibility. In Roth IRAs, you are ineligible to contribute if you are single and make over $161,000 annually. Married filing jointly can make up to $240,000 before they're going to be disallowed for making that contribution. And married filing separately has a very low threshold, which is typically why we don't see too many married filing separately couples making direct Roth IRA contributions, because that limit is only $10,000 of income annually. So now let's talk about the mistake I see a lot of people making. Most individuals I work with are still working and make well above the income thresholds for deductible traditional IRA contributions, and they make too much money to even be able to directly contribute to Roth IRAs. So they'll do something called a backdoor Roth IRA conversion. The idea here is to make a non-deductible traditional IRA contribution and immediately convert that contribution to a Roth IRA with no tax implications. That money grows tax-free and is distributed tax-free in retirement. But what they often fail to account for is whether they have money in a traditional IRA that is deductible. If they do have deductible contributions in a traditional IRA, they will be subject to the Pro-Rata rule, and part of that conversion will be taxable. So I'm going to walk you through an example because I think that'll help contextualize the Pro-Rata rule and what exactly we're talking about here. All right, so what we're looking at here is a graphical example of the Pro-Rata rule. So let's say we have an individual who for the past 7 years has made a $7,000 contribution that was tax deductible to a traditional IRA. Here in year 8, they want to make a $7,000 non-deductible contribution because their income limit has advanced past the thresholds, and therefore they're no longer able to deduct this contribution in the current year. So in the traditional IRA bucket, which is this column in the middle here, this person has put in $49,000 that was tax deductible, and let's just say for sake of example, this grew to $63,000 over the 7 years. And then they make this $7,000 non-deductible contribution, which brings their total traditional IRA balance in year 8 to $70,000. Now, what they want to do is they want to take that $7,000 non-deductible contribution in year 8 and make a backdoor Roth conversion with it because they think it's going to be a tax-free conversion. But what they're not accounting for is that 90% of this conversion will be taxable. And the math behind that is there's $63,000 in this traditional IRA right now that is tax deferred, and only $7,000 that was a non-deductible contribution. So when you make that conversion of the $7,000, 90% of that will be taxable. So in this person's instance, they're going to pay taxes on $6,300, and only $700 of that conversion is non-taxable. So for those of you who are over 59.5, that's only going to affect your ordinary income tax for the year. But if you're under 59.5, you're going to pay ordinary income tax plus an additional 10% penalty on that $6,300 taxable portion of the distribution if you don't pay the taxes up front out of cash that you have on hand. So this is what I mean when it starts to get really tricky down the line, when balances start to get really, really big and we do multiple conversions over many years, is that we can see someone increasing their taxable liability by hundreds of thousands of dollars for a simple mistake that they just weren't accounting for because of this pro-rata rule. So after going through that example, you might find yourself subject to the pro-rata rule. And now what I want to do is give you 3 of the more commonly used steps to help mitigate the pro-rata rule or wipe away entirely from and as an implication from your tax picture. So the first step you can do, and often what I recommend for most clients if it's allowed, is to roll pre-tax money into your employer's 401k. If your employer's 401k allows what's called a roll-in, you can move over your pre-tax IRA funds to your 401k balance. This removes the pre-tax balance from your IRA, leaving behind only the non-deductible contribution. You can then convert 100% of that after-tax balance tax-free to the Roth IRA because the pre-tax balance is no longer in there and it's subject to ERISA rules now that it's moved over under your employer's 401k. So you should use this if you have access to a 401k, a 403b, or a solo 401k that accepts those rollovers. And if you're continuing to plan to use backdoor Roth IRA conversions this year and then many years into the future. The key warning here is not all 401k plans are going to allow you to do this, so you need to check with your plan administrator. The second step you can take is to convert everything at once and absorb the tax hit. If you convert your entire IRA balance, the pro-rata rule no longer matters in the future. Yes, you'll owe taxes on the pre-tax portion, but future Roth conversions will be clean. This works in low tax years or if you have large deductions and business losses. So you should use this if you're in a low tax bracket for the year and you expect your tax bracket to grow in the future. And those expecting higher tax rates later and want to lock in today's lower rates, you should take advantage of this now. But you want to be very careful because you could push yourself into a higher tax bracket by converting too much at once. So thinking through the implications with a CPA or a financial planner would be great steps before converting a large balance. So somebody who has like $500,000 in a traditional IRA that's deductible, you probably don't want to do this because you're going to be realizing a good portion of that $500,000 upfront as taxable income. The third thing you can do is slowly convert over time into Roth IRAs. So instead of a lump sum, you can convert small balances each year. This spreads the tax balance across multiple years and keeps you in a lower tax bracket. You'll still face the pro-rata rule, but the tax hit will be more manageable. You should use this if you can't roll it into your 401k at work, but you still want to move to Roth. And those planning for retirement and optimizing taxes over time, this is a step you can take as well via these Roth conversions. So the key warning here is IRA balances still mix, so every small conversion will include a taxable portion as well. And I want to give you one bonus step that you can do to take advantage of working around the pro-rata rule, and that's just to keep track of your after-tax contributions. If you've already made after-tax or non-deductible contributions, you'll always file an IRS Form 8606. This ensures that you don't pay taxes twice on the same money when withdrawing or converting. So you should use this if you still want to make the non-deductible traditional IRA contributions, but you don't want to convert them in a given year. So anyone with those non-deductible IRA contributions, you can keep track of those in Form 8606. When those contributions are returned to you in retirement, the contribution portion or the $7,000 each year that you put in are going to be returned to you tax-free, and just the earnings are going to be subject to tax on the distribution. So the key warning here is if you've never tracked non-deductible contributions, you may owe more taxes than necessary. So you need to be cognizant or work with a CPA or financial planner who can help keep track of this. Because if not, I found a lot of clients are missing out on tax benefits from making non-deductible traditional IRA contributions. Now, you know why the pro-rata rule is often the most overlooked part of a backdoor Roth IRA conversion. And if you're looking for more tips from a certified financial planner, be sure to subscribe below.